Feeling a bit lost in the world of investing, not sure whether to invest in stocks or mutual funds? It's a common question, and understanding the difference is key to making smart financial decisions. Let's break it down. We'll explore the ins and outs of each option, highlighting their unique characteristics and potential benefits. First up, stocks. These are the building blocks of the market, and understanding them is crucial. When I buy a stock, I'm literally buying a piece of a company. You become a shareholder, a part owner of that business. Imagine grabbing a slice of pizza. That's your share. The bigger the company, the more slices there are, and your slice represents a small percentage of the whole pie. If the company does well, my slice gets more valuable. As the company profits and grows, the value of your stock increases. If things go south, well, you get the idea. The value of your slice decreases, and you could potentially lose money. Stocks can be exciting, offering the potential for high returns. But they're also risky. The market can be unpredictable, and stock prices can fluctuate wildly. I have to choose which companies to invest in, carefully researching and analyzing their potential. Keep an eye on news, constantly monitoring market trends and company performance, and accept that prices can swing up and down a lot, sometimes in a single day. This volatility can be nerve-wracking, but it's part of the stock market experience. It's all about picking winners, identifying companies with strong growth potential, and that takes time and guts. It requires dedication, research, and the willingness to take calculated risks. Now let's talk mutual funds, a different approach to investing, offering a more diversified and managed solution. Picture a giant basket filled with lots of different stocks, bonds, and other assets, all picked by a professional manager. These experts have the knowledge and experience to make informed investment decisions. Instead of betting on a single company, which can be quite risky, my money is spread across dozens or even hundreds of businesses. This reduces the impact of any single company's performance on your overall investment. This is called diversification, a key strategy in managing risk and achieving long-term investment goals. It means if one company stumbles and its stock price declines, the rest can help cushion the blow. The positive performance of other investments in the fund can offset the losses from the struggling company. Mutual funds are managed by experts who dedicate their time to researching and selecting investments. So I don't have to stress about picking stocks myself. It's a more hands-off approach to investing, allowing you to focus on other things. I just invest my money, choosing a fund that aligns with my investment goals and risk tolerance, and the fund manager does the heavy lifting. They handle the day-to-day management of the portfolio, making adjustments as needed. So what's the difference? Let's summarize the key distinctions between stocks and mutual funds. Stocks are all about control. I call the shots, making individual investment decisions based on my own research and analysis. But I also take on all the risk. The potential for high returns comes with the responsibility of managing your own investments and accepting the possibility of losses. Mutual funds offer convenience and lower risk, providing a diversified portfolio managed by professionals. Since my money's spread out, this diversification helps to mitigate risk and provides a more stable investment experience. But I pay a small fee for that professional management. These fees cover the costs of running the fund and compensating the fund managers. Let's look at accessibility. How easy is it to get started with each investment option? I can buy stocks with just a few clicks these days, thanks to online brokerage accounts and user-friendly trading platforms. But I need to know what I'm doing. It's essential to educate yourself about the companies you're investing in and understand the risks involved. Mutual funds are super beginner-friendly, offering a simple and accessible way to start investing. I can start with small amounts, making them a great option for those with limited capital. And I don't need to be an expert. The fund manager takes care of the investment decisions, allowing you to invest without extensive knowledge. Here's the quick recap, a concise summary of the key differences between stocks and mutual funds. Stocks give me ownership and control, allowing me to directly invest in individual companies. But with higher risk and more homework, requires careful research, analysis, and a willingness to accept potential losses. Mutual funds offer instant diversification, spreading your investment across a wide range of assets, and hands-off management, freeing you from the day-to-day responsibilities of managing your investments, but with a small fee. A cost associated with the professional management and diversification benefits. So, what's right for you? The best choice depends on your individual circumstances and preferences. It depends on your comfort with risk, how much volatility you're willing to tolerate in your investment portfolio, how much time you want to spend managing your investments, whether you prefer a hands-on or hands-off approach, and your financial goals. Are you saving for retirement, a down payment on a house, or another long-term objective? If you found this helpful and gained a better understanding of stocks and mutual funds, subscribe to Digital Jack of All Trades for more beginner-friendly finance tips. We'll continue to provide valuable insights to help you navigate the world of personal finance. Got questions? Drop them in the comments below. We're here to help you on your investment journey. Thanks for watching. Happy investing.